So today we'll look at the fundamentals of what a VC term sheet is. We'll look at some of those critical terms and the impact of those terms, what they actually mean. Look at some common pitfalls and red flags that you as a founder may have to look for, and some of the strategies you can take as a novice negotiator. Look, you're probably a novice negotiator. I'm just taking a wild guess there. But if you're a novice negotiator, what you can look at for a successful negotiation that works both for you and for your investors as well. So what is a VC term sheet? VC, to begin with, starts for venture capital, right? So what is a venture capital term sheet? It's non-binding. So that's the first thing to know. This is not a legal document. It is an agreement between two parties that they agree to work together before the lawyers get involved. So this is what happens before you get the lawyers to put together contracts. So it's a non-binding agreement that outlines all the basic terms of the investment. What it is, it's a blueprint for the final agreement, which goes to the lawyers. It clarifies all the work that the lawyers need to put into those contracts. It clarifies the key aspects of the deal. Now, it will include things like the valuation of the company, an agreed valuation between you and the investor. It'll be a part of the equity ownership. So what is the breakdown of shares in the business from yourself and the investor's point of view? Look at what rights, what rights the investor has. So if there's any sort of special conditions that need to be put in there, that is included in there as well. And the board composition, not all investors will be on your board, but in many cases they will come onto your board, particularly in a very early stage company where some of that guidance may be needed at the board level. And then there's what we call liquidation preferences. How is this thing going to be making money in the end? And how do people get in, out, and pay their way in, pay their way out? All the cash assets and the cash arrangements around the terms as well. So let's look at the valuation. This sets the company's worth both before and after investment. So there's an agreement that at the point of investment, the company is worth X amount of dollars, but it also sets what then the company is worth after that investment. Given there's an investment in the company, generally the valuation will go up. It also determines the share price that is set by yourselves and the investors, and the equity percentage that the investors have. So how much of those shares do your investors have, or the directors, or yourself in the case of a solo entrepreneur? Next step is the equity ownership. And this specifies how much of a percentage the investors have, how much of a percentage you have, and what the share distribution is among all those shareholders. So you might be mum and dad might be shareholders, you would be a shareholder, your business partner could be a shareholder, and then your investors will come in and be a shareholder as well. So the third component is the rights of the investor. So it grants very specific rights like voting rights on the board, or access to the data room, the information access. It also could include some provisions that protect investor interests. So for instance, if there is reputation clauses, all those sort of things, they may be mentioned in here, although they'll probably be picked up by the lawyers and dealt with there. At number 4 is the board composition. Who is on the board? What's the structure of the board? Is it 2 people, 3 people, 17 people? Obviously, you don't want too big a board because that makes things very, very complicated. What it does, it allocates the board seats to a mix of founders, investors, partners, all that kind of thing. So who's on the board? What's the composition of it? So you both agree before the legal teams get involved and start drafting up the legal documents. You'll have a very clear picture of both sides, what you expect that board to look like. And the 5th one, the liquidation preferences. So this sets the payout order in case of liquidation and sale. So this is where, say, for instance, the company goes up for sale, or it's liquidated, then who gets paid in what order? Is the investor paid first? Are the founders paid first? Are creditors paid first? This is very important to get right, because once it hits the lawyers and goes in the contract and that's signed, that's generally what happens when, say, for instance, something goes into administration or is liquidated. In what order are people paid? It also specifies the multiple of the original investment for the investor to get as a return. So when that liquidation happens, if there's a pre-agreement that says that the investor must walk away with at least 4 times their investment, or 8 times, or whatever the number happens to be, that's specified in that document up front. So some of the critical terms and what they actually mean to you as the founder, and also, I guess, from the investor's point of view as well. Let's look at those. There's the voting rights of dividends, the exit strategy clauses, what we call anti-dilution provisions, and vesting schedules. Let's see what they all mean. So the voting rights basically is what's the voting power of the shareholders? What things can they make decisions on? What things have to go to a vote? And who is having those votes? It kind of really sets out the types of decisions that investors have to approve of rather than just a general manager, for instance, approving of. Number two, the dividends. That's where you outline the distribution of the profits to the shareholders and have a definition on whether dividends are cumulative or whether they're non-cumulative. So the dividends are, they gather extra value as they accumulate, or whether they just are at a set value and they don't change over time. The exit strategy clauses, they detail the terms and conditions for all the parties exiting the investment, including the investors, the founders, the works. It includes provisions for things like mergers or an acquisition by another company or an initial public offering on the stock exchange. So no matter what the outcome is for that business, that if there's an exit and everyone wants to get out or just the investor wants to get out, here are the terms by which they will be able to get out. The fourth one is an anti-dilution provision. It's not about mixing drinks, but it's about mixing too many things in from too many people. So protecting the investors who are in here from being diluted in the next funding round. So for instance, they have a 30% shareholding in your business, but the next round comes in and that's diluted down to 2%. Well, these provisions are designed to protect that original investor from being sort of diluted out of the game altogether. What it does, it adjusts the conversion price of the preferred shares to maintain a percentage of investor equity that is suitable for that original investor. So yes, there's some risk in there, and there's definitely some arguments that will be had over that. But generally, if these things are all defined up front, everyone knows what's going to happen. It doesn't mean there is no dilution. It just means that there is a limit to those dilutions that happen. And the fifth one is those vesting schedules. So the timeline for earning equity over time. So you may start off with a 7% holding, but over time, as you contribute to the company and are a shareholder, that equity could grow or it could contract. But it protects the company by ensuring that everybody, including the investor and the board members, are in on the game. They've got a bit of skin in the game. So what it says is that basically, so your CEO who's in there, you may give them some equity and they get more equity over time. So they might start off with 1% of equity and you may say, stay with us 5 years, you get 5% of equity, which is a very, very big, a big incentive to stay on the board. The common pitfalls and red flags you need to look out for are these really overly complex terms. A term sheet is not a legal document. Remember, we leave that to the lawyers. They take care of the law side of things. What this should be is a guide. It's a bit of guardrails, right? To say, here's what we as investors and you as founders happen to understand this as. It's not overly complex, and you want to keep these things as simple as possible because the more expensive, the more complicated you make it, the more expensive the legal aspects are going to be. And it's just going to be really hard for people to understand. What all investors want is very simple terms. They don't want lots of complexity. They just want simple terms. If they've got lots of complexity, it means time, it means effort, it means a lot of risk. If there's a company putting forward massively complex terms, then there's an assumption that company is trying to hide something or trying to trick someone. So we don't want it to be hard to understand. We don't want to be confusing. We don't want massively lengthy documents or hidden conditions or language that isn't very specific and it's all ambiguous and could mean one of three things. We want it to say what it means and mean what it says. The unfavorable liquidation preferences are definitely a red flag to watch for. This is where, for instance, the investor priority is that investors get paid first. You may not want that to be the case, even though the investors may quite often call for that. They may also go, well, it's only fair that at the same time, the founders get paid. A low founder payout for you as a founder. Now, obviously, you want to try and avoid that because that means that you get less when the company is liquidated. It also can deter future investors if these things are in place. So, for instance, if there's any complex stuff in there, if there's any unfavorable terms, what it means is that the next round of investors will look at it as a less favorable investment. And then where there's multiple returns. So if there's a situation where there's returns for the investors here and here and here and here, and they don't seem to be getting anything else but returns, and there's nothing left for anyone else, that's not going to look great for you. Excessive control rights from investors tend to be a very rare thing in the venture capital world, because generally venture capital doesn't want a controlling interest. They just want to get in, get out. They're short term. They're not, wanting to hold your company for 30 years and own it outright. So these excessive control rights can be things like, having veto power over decisions that you will make as the CEO of the company, or some kind of dominance of the board where, out of the 4 seats, 3 of them are the investors. You don't want a situation where you've got no control over things yourself, and you don't want to have your decision making power restricted too much by investors. The other thing is too that investors can tend to want to have a bit of influence over the strategy of their business. So you've got to decide whether that's a good thing because they are qualified and experienced in that area, or whether they're just being overzealous and want to have too much control. Some future funding conflicts that could be red flags are things like dilution issues. The reduction in ownership stake due to new investments means it doesn't just affect the investor, it also affects you. Conflicting terms, contradictory clauses between current and future agreements. So if, for instance, the future agreements completely contradict the current ones, you're going to have a problem, and you're going to face probably a lot of legal trouble as well. We want to look at investor disagreements as well, the disputes over the terms, the control of the strategy. I think that becomes a very important factor, simply because people like to be clear. Investors like to be clear. Founders like to be clear. And then finally, the funding roadblocks. What obstacles are there that hinder the ability for the company and the investor to be able to draw in other investors as well? You don't want to be stuck where you're only stuck with one single investor and nobody else can come to the party in the future, because that does really limit your ability to raise funds and grow the business. So, how do we successfully negotiate all this? Well, it's just a matter of, yeah, being clear. We've already said that, but it's also about preparation and research, gathering the data from the data room so that we have all the information and all the market insights that are possible. Your investors are going to pretty much demand this anyway, but it's just good practice for you to have this all in place anyway. Looking at analyzing the terms by evaluating potential implications and the industry standards, look against other similar deals. A lot of this stuff is quite publicly available. Gosh, you can even do research through Perplexity AI or ChatGPT and see what's the norm for this kind of thing. Underestimating your leverage is by knowing your strengths. So know what your advantages are. What do you hold? What's your cat in the bag? What's your key strength in all this? And then highlighting the value of it. So showcase what your unique selling points is really clearly, really effectively, and very convincingly. This is where the charisma of someone who has a lot of belief and a lot of passion in their product and service will come to the fore. Build a negotiation team, select some members, define their roles, coordinate those efforts, prepare the strategy, review the process. If you want to effectively communicate, do things like active listening and make sure that you are not just sitting in a room, but you're actually taking all that in. I use for all negotiations, I use a thing called Limitless AI, and it's a recording app on my phone that doesn't record voices, but it transcribes. Because I can drift off a little, to be honest, when there's a lot of technical talk and there's a lot of financial talk. I tend to sort of drift off a bit. So when that happens, I've got my notes ready to go on my phone that I can refer back to at any time on any device. A little bit of clarity, a little bit of conciseness. We want to make sure that everything we're communicating is clear and direct. Likewise, we'd expect the same from our investors in return. And I guess the final bit that we need to look at is the assertiveness. When you clearly express your needs and clearly express your preferences, then you're in a much better position to have those things not just heard, but considered and voted towards as well. You are not at the mercy of your investors, and the investors are not at the mercy of you either. So it's very important that your opinion, your voice is heard. When it comes to it at the end of the day, navigate venture capital term sheets with clarity, with some strategy, so that you can secure a great success for your startup. Remember, it's the investors are a tool. They are a part of the process. They are not running the startup for you, but they do need to see some clarity, some really convincing, unique selling propositions, and have some confidence in you as a founder in order to come forward and help not only they to achieve their goals of returns, but your goals in growing an amazing business in the future. I'm Dante St. James, Director of Innovation and Investment Readiness at Darwin Innovation Hub. You can reach out to me through my email address on the screen right now, or just visit our website, darwininnovationhub.com.au, to learn more about the Start NT program, which helps you go from the very, very beginning processes of wanting to start something big and then moving right through to being ready to take investment. I'd love to have a chat with you, even a coffee if you're in Darwin. If not, hey, Zoom and Teams are there as well. Thank you and have a fantastic week.